over a rolling 5 to 10 year period in a high growth market like India, as long as you're invested in good quality stocks, it's very difficult to actually lose money.
I want to discuss on different facets of finance, on different areas of finance. So the first question is, there's a lot of news-based trading that happens, a lot of tips ke upar bazaar chalta hai kind of trading happening. Also, SEBI is becoming more and more vigilant day by day, and they've increased compliances significantly, which again has its pros and cons both. So now when we are looking at the amount of data that is being published, where the traders are not making money, so how do you look at the ethics part of it in long-term investment implications?
And the fact that I have read that SEBI study which you're referring to, which says that 99% of traders actually lose money. I don't think that has got anything to do with the ethics as such. I think trading in general is a very tough game, and the odds are basically stacked against you most of the time, especially when you're doing futures and options. The base rate of success in that particular field is abysmally low. So why even try to play that game unless you're great at it?
And that too leveraged.
Exactly. So basically leverage, shorting, derivatives, all these are taking time bombs waiting to explode in a period of market volatility. So as a result, many traders can get wiped out very, very quickly. So why play a game when the odds are stacked against you? I would rather play a game where the odds are heavily stacked in my favor. And long-term investing is that game. So because over a rolling 5 to 10 year period in a high growth market like India, as long as you're invested in good quality stocks, it's very difficult to actually lose money. If you're invested in good quality businesses with growth. So as long as you don't pay absurd valuations, over the long run, you'll end up making a pretty decent sum of money. And ethics in this industry is non-negotiable. Since you mentioned that very important point, and I'm a CFA charter holder just like you, and both of us follow the CFA code of ethics. That's a very, very important piece in the entire curriculum. And in this industry, as a fund manager, basically what are we selling? We are selling just two things: our investment philosophy and trust. And the second part, the trust factor, that is completely driven by ethics only. So, just treat your clients as you would like to be treated, and the outcome will take care of itself. We have seen so many recent cases where SEBI, like you mentioned, has become very vigilant, and so many things have come out. And Warren Buffett has taught us that it takes 20 years to build a reputation, but just 5 minutes to lose it. And people falling prey to greed and the lure of quick short-term gains, and losing a lifetime of value creation because they think short-term instead of thinking long-term. And there is so much money to be made in the middle of the playing field. Why go near the corner or near the edges? I think that's why being a CFA charter holder and upholding these code of ethics is so important.
So I was going through this blog of Morgan Housel, and where we talk about long-term investment and the returns of long-term investments and all. So it talks about that we all say that it's important, but the amount of patience that it requires and the number of short-term glitches that you have to be comfortable going through in order to stay put in that long-term, that is where kind of I believe people falter. Yes. So coming to the next part, how the bear market has taught you about investing. Can you give me a little idea in terms of assessing the financial health of a company? How do you look at the annual reports, the financials of the company, particularly in bear market context? How do you do that? During bear markets, what is something specifically you'll be looking for while analyzing the financials?
So like I mentioned in the beginning of this interview, that the biggest lessons of investing are learned in a bear market, and they bear fruits for an entire lifetime. So just like we are seeing today on the basis of order book increasing or any new contract wins, the stock price just start going up. The same phenomena was in force between December 2013 and December 2017, because in a bull market, investors tend to focus on the income statement, reported profit growth. But the astute investors, the good investors, pay attention to balance sheet, working capital, and free cash flow. And these three important aspects are what lead to long-term sustainability of the business. This is what a bear market teaches you, because in a bear market, what will happen? These negative operating cash flow companies, stocks, are the ones which will simply fall off a cliff. If a business has got negative operating cash flow, that means it necessarily has to depend on capital markets or debt markets for its financing needs and to keep its operations sustainable. But the moment funding dries up during the bear market, these companies basically go out of business, and owners of these shares end up with permanent loss of capital. This is why, when you talk about assessing financial health of companies, always focus on the three aspects of balance sheet, working capital, and free cash flow. Very, very important. For example, in the balance sheet, check for the debt to equity ratio. See if the working capital cycle is not too elongated, and because if debtors days are too high, then that may lead to negative operating cash flow. Finally, along with this, the free cash flow, because you need that operating free cash flow to fund your financing and investing activities. So balance sheet, working capital, free cash flow, all these things are very, very important to analyze. But don't wait for the bear market to learn this lesson. I learned this lesson the hard way in 2018, 19, and 20. I don't want the audience to make the same mistake. So even if you're investing in similar kind of stocks in this bull market, be very careful. You should understand that if a business is very working capital intensive, suppose 200 days, 250 days or more of working capital days, if the business tries to grow faster, it will require even more working capital to sustain that growth.
Yeah.
So that business will end up taking working capital debt. And as a result, after that, what will happen? That company will start doing a QIP or a preferential allotment. And you'll always see this line. This fundraising is being done to reduce working capital. That is one of the clearest signs through which you can understand that this business is good for a bull market trade, but not a sustainable wealth creator over the long run.
So we're essentially looking at liquidity short term, we're looking at solvency long term, and we're also looking at the turning the working capital part, and the profit, the income statement aspect is going to be there in both the bull and bear market. But during bear market, the other factors are going to be pulling down the stock. So we look at all these factors together in order to take a call with the company and accordingly stay invested.
If you get a sense that a bear market is about to begin, do a quick review of your portfolio. If there's any negative operating cash flow stocks or funding can be a problem, get out of them at the very first instance, because those are the stocks which will crash the hardest. Like in between from 2018 to March 2020, these kind of stocks fell more than 70 to 80%. Once you're down 80%, effectively you're out of the game for many, many years. Because in this business, it's all about return of capital before return on capital. This is what this bear market has also taught me. I've talked about in this book as well.
So just one personal question over here. So since you mentioned about, as you notice that the market is changing, there is a inflection point in the market, we are looking at entering in a bear market. And I like to play the very, very long-term game personally. So how do you identify that inflection point that we are about to enter? There's going to be a turn of events. So how do you identify that?
Again, like you mentioned some time ago, the classic conditions for a bear market to begin is basically high valuations on peak corporate earnings and inflated margins and tightening liquidity from very loose levels, because liquidity is the mother's milk for a bull market to happen. So once liquidity starts tightening, that is when you know that you are on the verge of a bear market. So very recent example, from 1st October 2021 to 31st March 2023, over 18 months, it was a long drawn shallow bear market in which the small cap index fell 20%. So in that kind of a market, only bottom up stock pickers managed to do pretty well. But because in the last 10 months we have had such a strong run, people have forgotten that 18-month period when it was very challenging for many investors. Similarly, between February 2022 to June 2022, the small cap index fell 30%, 30%. That's a big, huge fall. And many stocks fell 40% or more. But again, we have forgotten about it because it's been almost 2 years now. So these cycles will come and go. But good investing will eventually make you money sooner rather than later.
Right. So since you mentioned about you maintaining an investment journal, I understand the importance where even we set goals for ourselves that this year I'm going to do this, New Year resolutions and all. It's very important to have things written down so as to be able to go back in time and evaluate, doing that variance analysis that we do in finance as well, where what are you forecasting and what the actual figures turn out to be, and we try to make a reconciliation between the two. Absolutely. So moving forward to the next question. So say suppose you have a stock already in which you made an investment. Now there is some kind of a corporate finance, a capital budgeting decision that the company is taking. Let's say with regards to acquiring a new company or coming up with a new factory or something, or some kind of a corporate decision that they are taking, which is going to be quite impactful. So how do you look at these kind of decisions by the management and its valuations? Are you going to be bothering about the small little decisions and going to keep on updating your analysis, or it's the larger ones that you bother and get into the analysis? And how do you go about that?
Right. So the market is very, very efficient, and the market is basically conducting a DCF for all the stocks listed in it all the time. This is how the stock market actually operates. So, give an example of an order win. So, in that case, what will happen is management will clearly mention over how long will this order be executed, as well as the expected margins on this particular new order, or you can get this information on conference calls, and then the analysts start basically updating their DCF models that, okay, let's add the incremental revenues over this time period over which the order will be executed, take these margins, and then looking at the historical trends in the working capital cycle, etc., then they arrive at the free cash flow of the business, and then the models are updated. But honestly, you don't have to do all these detailed calculations on a spreadsheet. To be a successful investor, I need to have a DCF mindset, focusing on drivers of terminal value, because that is what drives valuation derating or re-rating. Because 80% or more of an intrinsic value of a business lies in the terminal value, which lies way out in the future. So, as long as you have a good grip on whether this business can sustain for a few decades or more, I think broadly you'll do just fine. But the problem with these deeply cyclical businesses is that you cannot really forecast more than 2 to 3 years out, because they're so lumpy and so erratic and volatile. So that's why in the stock market, many newbies who enter the market, they observe that, okay, here is a defense company or a railway company which is expecting 40-50% growth for the next 2-3 years. Why is it being given a lower valuation multiple than a FMCG business, which is forecasting low single digit growth or low teens growth for the next 2 decades? It's because the longevity of growth is valued more by the market than the rate of growth. So, longevity, predictability, sustainability of growth is what basically gives you very high valuation multiples in the market, because consistent growth increases valuation and consistent disruption decreases valuation. So the longer you can forecast out into the future, the more valuable the business becomes. And that's why such businesses get very high valuation multiples in the market. For example, the stock market right now thinks that EMS is going to be a decadal theme. That's why even though these businesses are low margin businesses with no entry barriers, still the market is giving a very high valuation multiple, because the market feels that there is a decadal runway of growth ahead for them. This is basically how the market operates.
Actually, when I think of it, as you were mentioning, I was thinking about quite a few stocks. The moment they bag orders, and I've seen this not only on the positive side of the cycle, but also on the negative one, wherein if there's some kind of news or something, suppose a company is making, let's say, 100 crore loss or 100 crore fine or something, I've seen the valuations dip below by more than 150 or 200 crores as well. Or even the increase is kind of not justified. So the market somehow always seems to overreact to an information, and then it kind of settles down. We were talking about how efficient the market has become, how quickly people are analyzing the data and incorporating it in their valuations and analysis. So you got to be so quick and so early in doing that analysis and incorporating that and taking a bet on whichever stock you're looking at. So because in your book as well, you've mentioned about the fundamentals aren't exactly what describes or defines the price of a stock. So how do you look at the intrinsic value of the stock? What is your approach to equity valuation from a company perspective?
A very good question, Aswini, and I would like to take a few minutes to explain this in detail, because there's so much mystery and enigma around the P ratio and what the right valuation multiple for any business.
Yeah.
So here I would like to quickly just dispel these myths once and for all. And here I would like to recommend 2 white papers to your audience. The first white paper is called "What Does a Price to Earning Multiple Mean?" by Michael Maupassant, and the second white paper is titled "The P Ratio: A User's Manual" by Epoch Investment Partners. If you can just read only these 2 white papers, then you can find out the justified or fair P multiple for any stock in the world through an interplay of 2 things: ROIC, return on invested capital, and growth. These are the only 2 factors which drive the justified P ratio for any business. And once you figured out the justified P multiple for any business, if you can buy that business below the justified P multiple, then over time you'll benefit from earnings growth and you'll also get the benefit of valuation re-rating. And if you buy a business above the justified P multiple, then value will benefit from earnings growth, but you can be also subjected to valuation re-rating also over time. So just keep things very simple. This is how basically you should approach valuation. Read these two white papers. They'll tell you everything you need to know to understand what should be the fair P multiple for a stock. For example, 35-40% grower with 15% ROIC should actually be given a lower valuation multiple than a 15% grower with 40% ROIC. But this is not intuitive because people think higher growth should have higher valuations. No. All else equal, a high ROIC is good. The same cannot be said for growth. So read these two white papers, understand what is the right valuation multiple for a business. Along with this, you can also incorporate a tool called reverse DCF or a reverse discounted cash flow operation. There's a website called Tijori Finance in which you just simply put in today's price and it will automatically tell you the implied growth and margin expected
by the price.
The business. In some businesses, you can clearly see that the market expectations are just being very, very unjustified. In that case, you can take an easy sell decision. In other cases, as long as you agree with the market's expectation, you can hold on. And in cases where you think that the market is greatly undervaluing or underestimating the growth potential of the business, then you can increase your allocation. So use these different tools, read these two white papers, use the reverse DCF tool of Tijori Finance. Trust me, your base rate of success in investing will go up rapidly.
Okay, I've not gone through the two papers. I'm going to definitely do it. I've gone through quite a bit of research in terms of P, but not these two particular papers. And with the reverse DCF, I had a sense of where we are looking at, because growth rate is predominantly, we can kind of estimate a required return. We can kind of estimate your, current dividends. And the problem that happens is with regards to forecasting growth predominantly. And if I can back calculate growth from the implied prices and kind of tweak and understand whether it's going to work or not, sounds quite promising, actually. So, my next question is, when we're looking at managing interest rate risks, credit risks, and you've mentioned about how liquidity becomes very important in terms of defining whether it's a bear market or we are looking at entering into a bear or exiting a bear market with regards to liquidity tightening. Then we've talked about how the working capital aspect and the liquidity aspect, free cash flows and all is very important when you're deciding on to the longevity of the sustainability of the company. So how do you look at the interest rate and the credit risks and all associated with the company? That is one part. So it's a two-part question. And second, how do you manage the idle cash in your portfolio?
So cash in the portfolio is a function of the opportunities in the market. If the valuations are very expensive and the current portfolios also become very expensive, then it's prudent to sit on cash. That's not a problem because it's all about opportunity cost. And each incremental incoming funds from clients has to be put to the best possible use. So that's basically how I treat cash. It's basically a call option, opportunity and optionality. Basically, it makes you more anti-fragile and it gives you bear market buying power. I think that's the biggest advantage of cash. The role of interest rate goes, that is the single most important determinant driving market liquidity and valuations, because like Warren Buffett has taught us, interest rates act like a force of gravity on valuations. In a zero interest rate environment, all these new age businesses which will derive their earnings far out into the future, their valuations their stock market capitalizations was actually justified in a zero interest rate environment. But the moment the interest rates went from 0 to 5%, because these long duration stocks, intrinsic value is hypersensitive to changes in interest rates. That's why you saw many of these stocks crash 50-60% after the interest rates started going up. So that's why value started outperforming, because value stocks by definition have got near-term free cash flow, they've got near-term earnings, and in a high interest rate environment, they tend to outperform the long duration businesses stocks. This is how a good understanding of interest rates can help you understand the market cycle and help you position your portfolio accordingly. There's nothing wrong in investing in these new age businesses as long as you understand the market cycle, that is the trajectory of the interest rates and liquidity. They are basically a leverage play on the interest rate cycle and the liquidity cycle, these new age businesses.
So we're looking at the likes of Paytm, Nykaa, etc., which are kind of loss-making at the present and promising for the future, and the way we've seen their valuations come down drastically. And also the same thing with the startup space, if you look at it. I mean, where in the very, very long term, you're going to be making money. Particularly, these guys also had a major problem with regards to the fund flows. So anyways, taking to the public equity markets.
reading and just being aware and up to date about what's happening in different industries. It's key to becoming a successful investor. And as Peter Lynch has taught us, more rocks you turn over, the more opportunities you find in this domain.